I'm Amy, Head of Learning and Development and Support at TradeShield. Welcome to another Credit Thursday. We're so happy to have you here. So for those who have never joined us before, every Thursday we host a session where we're just discussing different topics within the credit space. It may be from active, it may be from a credit onboarding perspective, a credit management perspective, or maybe even just a credit general. So we talk about everything credit so that we can help you grow your knowledge together as well. So this is a place for you to also speak to us and to speak to each other, and it gives us that platform to be able to work with like-minded people. So we're going to be focusing on something that sits at the heart of what we do as credit professionals, and that is the gap between reading the financials and actually making the decision. And knowing that a lot of teams are very strong on the analysis side. So, now that you've hopefully learned from last week and the week before about how to interpret those financials, but the real value comes from how do we translate that into a decision that protects the business, okay? And we're not talking about the customer that you're onboarding, but we're talking about you as a company as well. So making smart decisions. So whether you're using TradeShield or running your own internal processes, that's what we'll be covering today, and is directly applicable to everybody in their day-to-day decisions. Okay, so just some quick housekeeping. This session should run for about 50 minutes. We'll give you a few minutes at the end to ask some questions. You don't have to wait until the end if you want to pop those questions into the chat. Neil and Martin are also on that chat as well, so we can then help you as we go along. Okay. So the agenda today, let's run through this quickly, what we're going to be covering. So essentially, we'll be going through the full credit decision journey from the moment that you receive the financials all the way through to signing off on that credit limit. So we'll look at how to move from the analysis to the decision, how to translate financial strength into limits and terms, whether other factors influence your recommendation, common mistakes to avoid, how to build a consistent, defensible process, and then, of course, as I said, feel free to ask any questions at any time. So let's jump right into it. So let me start with asking you a question. Has someone ever approved a customer based on strong financials only to be surprised later by bad debt? Pause there for a second to say, if you want to contribute, you can. But you're definitely not alone. Let me just say that. The key thing to understand with this is financial statements tell us what has already happened. So if we look at it, we're saying, the financial period that you're looking at is this year and maybe the year before, or last year and the year before that. So it's things that have already taken place. But your role as a credit professional is to decide, what should we do now? What should we do next? Okay. And that's where the journey comes in. So we've got the raw data, the analysis, the risk overlay, and then the decision. So each step that we have adds value, and if you skip one, you increase your potential risk, okay? And so your quantitative analysis gives us structure, things like ratios, trends, cash flow, but these are all your qualitative judgments that gives the analysis meaning. So you have to have these, different steps within your process in order to understand it. Now, the best credit decisions and professionals, they don't just calculate it, but they interpret the story behind it. So it's no longer a matter of, did your ratio, 2 to 1, 2 to 3, are they up, are they down? But what's the story behind it? In other words, you may have a lot of stock on hand, you may have a lot of cash on hand, but you may not be a profitable business. And I know we speak about this internally as well. Like the goal of businesses back in the day was to be a profitable business. But the goals of today is to be a growing business. And so sometimes it's allocating funds internally to grow your business, which means that you may not be profitable, but you are growing and you're investing and you're doing other stuff. So it's the story behind it. Okay, so one important reminder is that the analysis is not the decision, but it informs us about the decision that we need to make. Okay, so what's the first thing that you should look at when you open a set of financials and why? So let's start with that. Okay, so once you've done your analysis, now you've gone and read these financials, right? So you've gone to look at their assets, their cash flow, their ratios, all of that information you've gone to now look at, their vehicles, etc., their holding companies, anything that you're going to get from those financials. And what you're going to do is now we're going to turn it into an actual number and or payment terms. Okay, so how do we do that? We start with capacity. So for those who understand the 5 C's of credit, capacity is looking at what is the affordability and that this customer can afford to spend with me. So what can this customer realistically afford to to have as a payment based on their cash flow. So we've also spoken about this in a previous session, which is around cash on hand. Cash is king. The more cash you have, the more liquid your business is, the more you're able to do. Okay, so they consider the leverage. So if they've already have like a highly geared program, a highly geared customer, the limit that you can safely extend to. So here is where you're going to want to say, okay, can this customer pay me in a certain amount of terms? What's the value that we can push them to? So within TradeShield, we look at it and we call it the maximum capacity, meaning how much can this customer afford to spend with me? And we look at it based on the fact that, a percentage of somebody's turnover, which is the amount of money that comes in, or their revenue, if you want to call it. We look at the revenue and we say there will be and may be other suppliers. Okay, some that may be in the same industry as you and some that may be in completely different industry. For example, if I would maybe be purchasing, I'm not a manufacturer, I'm a distributor, so I'm going to be buying from multiple different companies, so I may spend the same or similar with those different companies. But then I also have like hubcaps and nuts and bolts and oil and cleaning materials and tea and coffee for my staff. So the spend is not going to be the same. In other words, I'm not going to spend with my tea and coffee supplier the same that I would with my tire supplier. So we have to then go and find out how much can they spend with you based on all this information. Okay, so we also then need to take into consideration a DSO. So what is a DSO? Daily sales outstanding. This is a big signal for us. So the DSO is, if their DSOs are increasing, it means that their customers aren't paying them on time. And the pressure will flow directly to you because they then won't pay you on time. So then this translates to the strength into terms. So how can they pay you? And I'm going to pause there for a second. And I know I didn't make you a slide, Martin, so I apologize for this. But I know we spoke a little bit about not just DSOs, but it was PSO. Was it PSO?
DPO. And that is how quickly does your creditors pay you again? In other words, the DSO is how quickly you receive your money and how quickly you're getting paid. Now, that measure can be calculated out of a balance sheet as well. So if my DSO as a company, if you look at my financial statements and my DSO is 48 days, but my days pay outstanding, DPO, is 70 days. That means I take 70 days to pay those who I owe money to. So now, critical thing that we look at when we look at this as someone who wants to increase a credit facility. Recently, I had to look at someone's financial statements on behalf of one of our clients, and they wanted a certain limit over 30 days. However, financial statements of this client revealed to me that the DPO is 67 days, and they are talking about 30 days, and they're talking about a substantial amount. And I know the industry well, and I know that the margin in that industry is usually very small. So immediately it tells me two things. They're going to pay me slow, and I'm going to have very little of my margin left, if any. So am I going to chase turnover, or am I going to chase profit, making money? That's the critical question. So not just looking out for the DSO to see how quickly they collect their money, but also looking at the fact as to how and when do they pay those that they owe money to, and make sure that those two are fairly closely related and closely linked. We heard Raheel spoke about it last week, and he said, What is the DSO? What is the DPO? And how close are those to one another? If your DSO is older than your DPO, it means you're collecting slow and you're paying up. You're bleeding money. And that means you're going to find yourself in a cash-strapped situation. If it's the other way around and your DSO is 38 days and your DPO is like 42, 43 days, it means you're collecting money, paying out. But if it's a big difference, could mean one thing. Firstly, it could mean that you are waiting for your money to come in before you can pay out. But my DSO tells me a different story. It says you already have the money. So what are you doing with the money? Are you just sitting on it and earning interest on it? Or what are you doing? So those are the two things that you can look at. Thank you, Amy.
Thanks, Martin. And maybe you can also just explain, I know we just recently had a scenario where you were assisting a client of ours to have a look at this. What information did you ask for to say, let's go and have a look at this? So what did you ask the customer for in order to make that determination?
The DPO calculation is your trades payables, but that was your accounts payable, divided by your cost of sales times 365. That's
okay.
So you have to have your cost of sales and you have to have your trade payables. Those are the two figures that you have, and then you can calculate that. Like in a DSO, you need your trade receivables and your revenue, and you do a calculation times 365. That tells you how your annualized DSO looks like. This is the annualized figure. And then in the DPO's instance, it is trade payable, cost of sales, and 365, and the calculation around that. The one is DSO, one is DPO. So you need to have turnover, you need to have cost of sales, you need to have trades receivables, and you have to have trade payables, and you need to understand 365. Pops your uncle. That's the information you need.
Love it. Maybe we can pop that into the chat while we're discussing. So if anybody wants to grab that calculation, they can. But basically, this translates.
It's actually in Rahil's.
In his slide. Wonderful. Okay. You see, I went on holiday and then everything falls down and I miss out. I'm going to have to go watch that video. Okay. I know. Thank you so much. So what this translates to in strength of terms is stronger customers can justify longer payment terms and weaker customers may need shorter terms. So some companies only offer a specific type of term. In other words, they only do 30 days. And some people then offer, let's say, for example, cash on delivery, 7 days from invoice, 30 days from statement. So you may have those different options to say that the weaker customers I would put on a 7 days from invoice and then let them work their way up to a proven track record. And those that are able to then do the 30 days, because of course that means that we also need to take into consideration different costs of our business. The longer someone takes to pay us, the longer we don't have cash in the bank. Okay. So again, for TradeShield users, the platform gives you a starting point. So not the final answer, but the starting point. But your professional judgment is what makes that decision defendable. So we spoke a little bit about this, and we actually had a really great talk by Sean from AVI. He's the group credit manager, and he said, that we can use lots of different data points. You can use financials, you can use credit reports, you can use data and analytics, but you still need to make a decision. So even from TradeShield, we make a recommendation, but we don't make a decision. So your professional judgment is still required. And for any CFOs on the call, a credit limit is not a sales tool, it's a risk management tool. So, and that's also for salespeople, not just for CFOs, but it's also for a sales team as well. So the limit that you set essentially is a promise that you've managed the risk responsibly, to say, I've done the assessment, I know you're a good candidate, therefore longer terms are applicable and the risk is lower to our business. So some key factors that influence that credit recommendation. So credit decisions are never made on financials alone. Like I said, there's lots of things that we need to take into consideration. So let's look at that broader picture together. So first, financial performance, but we don't just look at revenue. We look at margins, we look at sustainability, we look at DSOs, we look at all that information that we've just spoke about. Then there's the business quality. So what industry are they in? Is that industry stable? Is that industry under pressure? And is management experienced? So we do look at that as well to say who runs this company, and it's a part of your credit report that you should get to say who are these directors? How many other businesses do these directors have? And what do those businesses look like? Why? Because that tells me, are you a good business person or a bad business person? Are you a person who's stretched too thin? Are you the sole director, but you've got 5 other businesses? How are you managing those businesses? What teams do you have on the ground? So we're going to be wanting to look at that. And something that we may now need to take into consideration is this global impact that we're going to be facing. And that is, there is a war taking place in the world that directly affects oil. And oil means that we can't export. It means that our delivery costs are going to go up. And so that affects all these businesses. So now when you're making decisions, you need to take that into consideration. For example, against something that Sean was pointing out to us, was he was saying, that goes to Germany. And as a result of the current war, they may not be able to do that export, which counts to billions of rands worth of sales. And so they have to then decide, how are we going to get it there? Are we going to change the direction? We can no longer go by ship. Are we going to go by plane? What will that effect have on the product? How will we keep it cold, warm, hot, whatever the process is? These are things you need to start taking into consideration. So what industry are they in? Are they affected by global, outside environments as well that may affect their business? Are they in the logistics industry where petrol that is now going to go up? Are they paying for flights where there's now extra tariffs? So these are things we're going to start wanting to think about, even though it feels that the war is very far away, but it does impact us on the home front. Okay, so relationship history is also a key. So, do they have other suppliers? Do we know who they are? Have they got a reputation? Have we looked them up online? Have we looked at their website? These are things we want to have a look at. So how have they behaved as well? So, there's different ways to look at behavior. One of them is payment profile information. An historical way of doing it would have been through trade references, and to say, how do these people behave? Do they pay on time? Do they communicate with us? Communication is very key as well to say, on your first interaction, how quick were they to respond to you? Because that also means that if they have a good, healthy way of processing information and communicating with you, the chances of you getting paid on time are also higher. So external factors matter more than what we sometimes think. Things like FX exposure, economic downturns, markets, their markets can significantly increase the risk. And then there's the structural factors, ownership, group structures, guarantees. These can either be strengths or weaknesses. We came across an incident the other day where there was a PTY who was owned by a trust, and that trust was owned by another trust, and that trust was owned by a holding company of 5 different trusts. So ultimately, who's the main owner of this entity? Who's the person that's going to be responsible for the debt should things happen? So ownership structure, group structures, understanding where the financials fit in. Are you a separate legal entity? Should you have your own financials? And we see this often, Martin. I know you see this often where we come to you with questions to say somebody submitted financials of the group, but they are not wholly owned by that group and have their own set of financials, and the group is not responsible for any outstanding debt. So they provided you with these financials that look phenomenal because they've got billions of rands, but actually it makes they only own 50% of that business, and therefore, they wouldn't pay for it. I don't know if you want to add on to that, Martin, based on your experience, where we see financials not being the true reflection.
Very, very, very much so, Amy. I've heard so many times where the sales guys come in and say, but they are owned by such and such a company.
Mm.
It doesn't even mean if they're 100% a wholly owned subsidiary that the holding company is responsible for the debt. If you have a cross-company guarantee in place, we spoke about guarantees. With other words, the holding company gives you a writing to say, we will guarantee the debt. Recently, one of our sales guys came to me, or one of our key accounts managers, and said that one of our clients have got a letter from the holding company to say they will stand good for the debt of this company. We must give this company a credit limit of R1 million. I then said to him, but is that holding company worth the R1 million then? So there's so many things. Once again, you got to go and look down the chain. So even if you have a cross-company guarantee, go and look at the holding company, because you might find that they're just a shell company and they've got absolutely no assets. So even that might not mean much. They hold the shares of all these other companies, but that's once again a very lengthy process to start selling shares and selling off businesses to make money, to give you money, to bring liquidity back into the business so that they can help. Very careful, as Amy said right in the beginning, don't look at one factor in isolation. Look at all of those things. So you open the balance sheet and you see cash in bank. Wow, they got cash in the bank, lots of it. So look at accounts payable. Have they paid all their creditors? And you might see that the creditors are quite large and there's quite huge amounts outstanding. So no, very good. After they closed that balance sheet, all that money went out of that bank account as fast as a lightning bolt to go and pay their debt. So don't always just look at something in isolation. Take the time, do the calculations, do the ratio, understand what the ratios mean and the outcome of that ratio before you start making decisions. Don't just look at it in isolation. Thank you, Amy.
And I think that also highlights for me, Martin, where you said, make sure that you've got your securities and your cross-company guarantees, whatever it is. And if you've got surety, and they've put surety according to certain assets, go and validate those assets, go and get the property deed searches, go and get a evaluation of whatever it is that they're putting up as collateral before you make that decision. Because I can say, oh, I have a house, it's fantastic, so you can just take my house. It turns out that I am married in community of property, and it turns out that that house belongs to my partner as well, and you would have required his consent and signature on that surety, which would make it null and void if you didn't. So there's all these types of things that you need to then take into consideration to make sure we've checked everything that the person has said. Or alternatively, I've said that the house is worth 5 million, but it turns out that actually 3 years ago, when Durban got washed away, the other half of the house got washed away with it, and then the plumbing and the electricity also went with it, and so that property isn't worth anything. So there's also that option as well, to make sure that we're checking everything that we're being provided. And then finally, we've got the bureau data. So we're going to be looking at statutory information. So are they in business? Do they have judgments? Who are these directors? How long have they been in business? That kind of information. And then, of course, if you are a trade show client, then you've got the trade show data and analytics insights that would guide you as well. And then you use this to support and challenge your view, but not to blindly rely on it. So you use this information to challenge yourself to say, did I do this? Didn't I do this? Would I go ahead and give this customer credit? And if I do, what terms would I then use? Okay, so the key takeaway is no single factor makes the decision. It's always about the full picture. So it's not just relying on one data point, but looking at all of the different factors that we have here as well. And you could have separated this amongst your different teams to say, my credit control team need to check the financial information and the bureau data. And then it's up to my credit managers to go and do, the assessment on the property evaluations and surety information. And it's up to my CFO or group credit manager to then go and have a look at, external environments that might affect his customer. And each level then gives their contribution as to what that decision would be. And of course, that lives internally and should be documented in your credit policy. Okay, and I'll just make that disclaimer here. If you currently do not have a credit policy, which dictates how your team should work, when they should do certain things, when they should escalate, where they should escalate, if you currently do not have a credit policy or you'd like to review it with myself or Martin or one of our other credit executives to say, how do I make sure that we're doing this right? Please reach out to your account manager or to support so that we can help you with that, to make sure that you have ensured you have the right processes in place. Okay, so let's talk about common mistakes. And this is a difficult one because most people don't like to admit that they've made mistakes, but everybody makes mistakes. And when I was in school, they used to say everybody makes mistakes, and then the principal's name that followed that. So just to be aware that mistakes are how we learn, but let's be aware and learn from everybody's mistakes. So this isn't about blame, but it's about awareness. Okay. So first, the anchoring on revenue. So big turnover can feel safe. Wow, look how much money this person has, but there's no cash flow. Then they can't pay you. So yes, revenue or turnover looks phenomenal, but they've got no cash in the bank. So cash in the bank tells me whether you can pay me or not. Secondly, ignoring the qualitative signals, so things like management changes, operational issues that don't show up in the numbers, but they do matter. So that's why you're going to want to look and see, have they recently had changes in directors? Maybe you should be, and Martin says this all the time, know your customer, phone them, ask them questions, stalk them on LinkedIn to see how long they've been in that position, because that gives you an idea of stability as well. Okay. Thirdly, relying too heavily on historical data. So looking at things that have happened in the past, and we often get this question about judgments. Do judgments dictate how the customer is currently paying? And Martin will tell you that no, he doesn't not disqualify judgments in general, but often a judgment is such a past view. It's happened more than a year ago in general, because first and foremost, they're going to default on payment. You're going to try and collect that payment, but you may have only started after they had defaulted after 90 days. Then your team, handed it over to an internal legal department. Then they listed them as a bad payer on the bureau. Then they went to take it to legal action, or maybe they tried an external, debt collecting company. And then they took it to arbitration. So by the time you see that judgment, it's a year later, and things may have gone wrong. It could have been a dispute. It could have been, a lack of payment or bad payment. And generally you would see that with multiple judgments, and not just one judgment. And also you look at it in the size of the business. For example, large corporates like a Checkers or a Mass Stores, they may have judgments against them, 10,000 Rand, 20,000 Rand, R1,000,000. Is that significant to that business? So you also have to understand, is that amount significant to that business? And sometimes it's also, who is that judgment from? So was it from SARS? Do they not pay their taxes? Or was it a landlord dispute? So we want to look at this information and interpret this information. Okay, so fourth, we have the inconsistency. So if similar customers get very different limits, your process isn't defendable. So you can't say, these customers all in the tire industry, you're on 7 days, you're on 30 days, you're on, 60 days. It becomes difficult to say, well, why did we make that decision? Where's this process that we've come to follow to say what our standardization is? It also becomes very difficult to manage. We have seen some debtors books where they have lots of terms, and that does make the process of who's actually overdue very complicated for our teams. Okay. Fifth is relationship bias. So long relationships do not eliminate risk. You may have had someone, Tongaat Hewlett's been trading with me for the last 80 years. But Tongaat Hewlett's is in business rescue. They haven't paid their suppliers. Their business is in trouble. So yes, you may have had an existing relationship with the company for many, many years, and you may even know them on a personal level, but that doesn't eliminate the risk. And we often see this taking place. Oh, my senior manager knows this person, and therefore they overrode whatever we said, and they said, let's go ahead and give that credit. And often it lands in disaster. And Martin, I'm sure you've seen this happen many a time in the real world scenario where this is taking place.
Oh, absolutely. When a company is sales driven, a lot of times when they're sales driven, they overwrite the credit decision. That's why I always say the credit policy doesn't belong to the credit department. It is a business policy. The whole business must accept it, and the whole business must abide by it to prevent things like this. Because sometimes people chase sales because they're now hard up for sales, and they land themselves into some deep water. Why? Because they took unnecessary risk.
Yeah. Absolutely. And then lastly is undocumented decisions. So if you can't explain your decision clearly, it won't stand up under scrutiny. So if you can't say, oh, I made this decision and why, and that is clearly documented on, if you don't use automated credit applications and you use paper-based applications, then attach the email decisions or have handwritten notes so that when an auditor comes to sit with you and says, why did you make this decision? You can unequivocally say why you did it at the time. Okay, maybe you made the wrong decision, but you made sure at the time you did your checks and balances, and that is why you came up with the decision that you did. So you need to be able to clearly defend your decision with facts. Okay, so here, this is which one of these, do you most often see in your business? I don't know if anybody wants to drop a comment in the comment box or raise your hand to say, which one of these have you seen either in your current position or in a previous position, and want to share a little bit of a war story there. Neil will tell me if anyone said anything.
Nothing in the chat as of yet. We'll keep you updated.
Perfect. But you also feel free to pop that into the chat, just a little story about what may have happened for you. So how do we bring this all together? Okay, so we use the structured 5-step approach. So first we want to gather and verify that information. We want to analyze and score that information. We want to assess the content. We want to look at recommendations, and then we want to document it and review it again, so that no single point does this happen at one person's discretion, unless your business is very tiny and that, that's the way you can do. But generally speaking, in the B2B space, there are multiple people, which is also why in a we call it a approval matrix, that one person should not be able to approve multiple or consecutive levels, because it needs to be an unbiased, objective way of going about it. So maybe one team is doing the gathering, another team is doing the analyzing, the next person is assessing the content of both of these areas and then making their recommendation to another person who's therefore going to document what they've seen and then make that and then send it to the next person for review to say, this is how I came to this decision because of these things, and this is how we got there. So it's very important to make sure that you don't have someone just saying, oh, our credit controller can approve it, or our credit manager approves everything, because it's not enough eyes and ears and checks to make sure that we're making the right decisions. What we have seen, it can be value-based. A lot of companies say, well, if it's a small customer and it's a small risk, then we're happy for that person to make that decision. If it's a larger risk, we then would need to escalate it internally and go according to that. Or they can say, with every account, no matter who you are, we will follow this particular process. So that approval matrix must be clearly defined. And then, a comment after each section should also be checked to say, I looked at this. These are my opinions about this. I did the financials. These are what I thought of when I saw the financials, and this is an area that I picked up on, so that when the last person has to go and look at it, they're not going to go redo your work, but they're going to check what you've said. They're not going to go and do that analysis again. Okay, so very important that you make sure that you understand who's responsible for what in your own company. Okay, so this isn't admin. It sounds like a lot of admin, but it's a professional standard. It should be a professional standard to make sure that everybody is checking, because often, and I'll give you an example, we had a case where a very large company applied for credit with another customer. That customer still used paper-based credit applications, and the person on the other end did not even read what was on that document, because if they had, they would have noticed that the person gave the wrong ID number in 2 separate places, okay, that the person had written almost nonsense throughout that entire credit application, and it turned out to be a fraudulent application. But this fraudster had financials, had copies of IDs, but the ID copies didn't match what was actually on the documentation, and they landed up approving the credit for a couple of million rand, and it was taken. And I don't know if they had credit insurance or not, but either way, if they had gone and done these checks, they would never have been in the situation that they were in, because it was blatantly obvious that this person had made multiple mistakes on that application, and that the director that they said that they were wasn't even listed at the credit bureau. So a lot of information that you would then check. And if you'd like, I'll pop a little, we've made a little checklist for what each person should be checking that might help you in your process. Martin, do you want to add something there?
Credit insurance is not even going to pay out. Even if you have credit insurance, in a fraudulent transaction, the onus still rests upon you.
Yeah.
Remember, that credit insurance says the company that we assessed is credit worthy. Now you say, oh, this company stole my money. It's not the company that they assessed. It's not Martin Petzer Pty Limited that stole your money. They pretended to be Martin Petzer. So the insurance company still needs to sue someone for the money. So they can't go and sue Martin Petzer Pty Limited for the money that you lost. They got to find that schnook that took the money, and therefore they will not insure it either. So you got to be so careful when you do things where there is no checks and balances in place to make sure whoever you are dealing with are who they say they are. I mean, one of the very simplest things in the world is when you receive audited financial statements, what's the first thing that you look for?
If it was signed. The first thing I look for is if it was signed.
Was it signed by the auditor? Was it signed by the directors? Was it qualified? Because that tells you that this auditor says this is correct and the director says this is correct. Now they are going to be held liable and accountable in a court of law for what they've stated to be correct. So that's why you must be so careful when you start looking at things. Don't say, oh, this is audited financials. Are they signed?
And by who? Like, did they get
So,
signed in by the director only? In which case it wasn't checked by anybody. So there's that other set of eyes to say, we need somebody else to be accountable that isn't a part of this business. We have also seen where a financials were signed by a auditor who was also a director. So, as a conflict of interest, we have seen that taking place, which is very, very tricky.
Or you see an auditor that you don't know where this guy came from. And it's all of a sudden, it's a large organization. I will question it as well. Because most companies will use reputable auditors to do their auditing.
Absolutely. So, the most important piece here is the documentation to substantiate your decisioning. So if your decision is ever challenged, your rationale is your defense. That's the truth of the matter, is that it's there, that should you need to go stand up in court and explain it, everything that you have said is there. So, and we see this often is when somebody has a comment on an approval level, they just say good account or approved. Now, in 10 years' time, when I come and ask you about that, it doesn't tell you what you looked at. And I saw that Renee posted in the chat that you could put a checklist for your team on your different levels of approval, which we love, and we would happily do that for you, to help prompt and ingrain into your team what they should be checking at each level. So what is each section and each person responsible for, so that we're not all doing the same work, but we're all coming to the same conclusion. So I suppose that means that consistency is equally as important. It ensures that decisions are based on individual bias. It's not based on, individual bias, but is a shared framework. So it's not just my decision. It's not just Martin's decision, but it's a collective decision that we came to together. And then there's the review. So then, a limit is set, and two years ago may no longer be appropriate today. So there's that consistent reviewing of your data to make sure that everything that was intact at the beginning is still intact, but also to say maybe there's opportunity here. So yes, when you joined us, and because we give you credit, your business has substantially grown, which means that there's more room for us to grow with you. And or alternatively, things have not gone so well for you in your business, and therefore we need to reassess and reduce that risk, so that we are not continuously saying, oh, but we have a relationship with this customer, but actually now they're bad payers and they have cash flow issues. We should be consistently reviewing those accounts. So you can do that in whichever manner you want. Some customers distribute their book amongst the year to say, if you've got 100 customers, we'll do 25 in each quarter. We'll go get credit bureau reports. We'll go get updated financials. We'll send them new applications, whatever it is that you do. If you are a TradeShield user, of course, this is done for you. And then, it just gives you that consistency, that documentation, and that ongoing review. So yes, we do all of the legwork at the beginning, but it's consistent legwork to make sure that we don't have bad debt. Okay, so today's session gives you, or should give you, context as to why different platforms help us to make these decisions as well. So you may have certain platforms or providers that you use to get this information from, or to correlate all this information on. But every feature that we at TradeShield, we built it around real credit management principles. So supporting your credit decisions, making sure that you have all of these different processes in place. Okay, so make sure that you build that into your own process, whether, again, if you use TradeShield or not, if you've got your bureau, if you've got your person who does your research online, so checking out websites, checking out LinkedIn, checking out SAPS, you may have those different processes as well. And so your capabilities are to build this process for yourself, to say, and this is part of that credit policy, to say, where do we get this information from? Who do we get this information from? And where do we put this information once we've gotten it? So ultimately, the goal is the same for everyone: faster credit decisions, smarter decisions, and more defensible decisions, to make sure that we can back up what we say. But this can take long. That's why we want to make sure that if we've got structured processes and platforms that help us do this, we can do it quicker. So maybe you don't want to do your own financial analysis. You send it through to another outsourced company, whether it be TradeShield or Moody's or any other company that's going to do that financial assessment for you, so you can just look at the outcome, for example. You have a team that's looking at your credit reports. You have a team that's getting security information and that kind of thing. And those are all being put together into one final big, beautiful, let's call it a package at the end of the day. So some key takeaways. So let's quickly summarize all the key takeaways. So these are the headlines from today's session. So you want to ask yourself and your team, which one of these is the most relevant to where you are right now? Okay, and so I hope you get that from after the session. And more importantly, what is the one thing you can change this week to improve your credit decision process? So go back and think about all these different processes that we've highlighted to you here and say, where are we falling short? Maybe it's in the document collection, maybe it's in where we store it, maybe it's in the communication, maybe, so there could be an area here that you say, actually, if we go and improve this one area today, and over the next quarter, this is going to be our focus, and then next quarter and the following quarter, we improve on different things. Your year that you will enter into for next financial year should look exceptionally different. And so just take from this, what's the one thing that we could change? And if TradeShield or anyone on this call can assist you with that, please reach out to us. And this is the time that I'll open up the floor for questions. And if nothing comes up immediately, you can always pop us a message. I saw that Neil popped our support chat for you in the comment section. But, most challenging credit decisions that you faced recently, these could be stories you want to share with us, what you're struggling with to get reliable financial information. We see it often, it's fun, it's confidential, whatever the case is, and if there's anything that you'd like clarity on. But otherwise, I thank you all for your time and I appreciate it as always. So I see there isn't anything in the chat, so I'll just give you a minute. Otherwise, for those who would like to drop off, thank you, and we'll see you next week, Thursday.
Thank you, everybody.
Thank you.
Awesome session, Amy. Thank you, Martin.
And you know what, Amy? I always say, review your review. In other words, constantly review how you do things. Don't just say, but we've always been doing it like this.
Oh, yes.
I've always been doing Marcus might not be the right way to do it anymore.
Absolutely.
There's
I
always
see
something new that can help you. There's a question there somewhere.
Yes, I see, Leona, you have your hand up. I have allowed you to use your microphone if you'd like. I'm sure you've heard this often, Leona, that you might be related to Hermione. Maybe she lowered her hand. Maybe she just wanted to give us a thumbs up.
Yeah, probably.
Perfect. So it doesn't look like there are any questions. Oh, she said it was by mistake. No problem. Excellent. Then we'll leave it there, and we will put the slides from last week and this week onto the Knowledge Center, and we'll pop you a message once it's done as well. Otherwise, we bid you
Fantastic.
adieu. Have a great day.
Have a good one, guys. Thank you.
Join us every Thursday from 10 to 11.